Bitcoin mining began as a hobbyist activity conducted on consumer laptops in Satoshi Nakamoto's first years. Today, it is an industrial operation consuming more electricity than many mid-sized nations, dominated by publicly traded companies with institutional balance sheets, and sophisticated enough to attract energy sector expertise, capital markets professionals, and sovereign wealth fund attention. For institutional investors in Bitcoin, understanding mining economics is not optional. Miners are the marginal sellers of Bitcoin, and their cost structures, balance sheet positions, and behavioral responses to price movements significantly influence Bitcoin's supply dynamics and price cycles. When miner profitability collapses during bear markets, forced selling from miners under cash flow pressure creates supply-side pressure that exacerbates drawdowns. When profitability is high, miners accumulate BTC rather than sell, tightening available supply. Beyond their influence on Bitcoin supply, publicly traded mining companies offer institutional investors an alternative vehicle for Bitcoin exposure. Leveraged, operationally complex, but potentially offering outsized returns versus direct BTC ownership in strong bull markets. This analysis provides the framework to evaluate mining economics with institutional rigor. The economics of Bitcoin mining reduce to a straightforward equation. Revenue equals the BTC price multiplied by the fraction of blocks the miner wins, which is proportional to their share of total network hash rate. Against this revenue stands the primary cost, electricity. Mining hardware is effectively an electricity to Bitcoin conversion machine, and the exchange rate of that conversion is determined by hardware efficiency, joules per terahash, and electricity cost per kilowatt hour. This simple structure creates a brutally competitive market. Miners with access to cheap electricity, whether through hydroelectric power, stranded natural gas, or favorable energy contracts, can sustain profitability at Bitcoin prices that force higher-cost miners to shut down or sell. This dynamic means that the global mining cost curve acts as a structural price floor. When Bitcoin falls below the marginal production cost of the network's most expensive miners, those miners exit and hash rate falls, reducing competition for the remaining miners. The halving schedule introduces a step function shock to this economics every 4 years. Block subsidies cut in half overnight, immediately halving revenue for every miner with no change in costs. The resulting miner shakeout, where less efficient operations become unprofitable, has historically preceded Bitcoin price recovery as supply-side selling pressure from miners diminishes. The long-term viability of Bitcoin mining as an industry depends on whether transaction fees can replace block subsidies as the primary revenue source. This is not a hypothetical future problem. It is a secular trend that every mining analyst must model explicitly. Each halving reduces the subsidy component of mining revenue by half, and the process will continue until the last Bitcoin is mined around 2140. The emergence of Bitcoin ordinals in 2023 provided the first meaningful evidence that the fee market can generate substantial revenue independent of base transaction demand. During peak ordinals activity in 2023 and 2024, fees as a percentage of total mining revenue temporarily exceeded 40 to 60%, demonstrating that Bitcoin's block space has demand vectors beyond simple value transfer. For institutional investors evaluating mining company stocks, the long-term fee market development is the most critical variable in any multi-year financial model. Mining companies with strategic energy positions, modern hardware fleets, and the operational scale to survive multiple halving cycles are the ones that will exist when fees become the dominant revenue source. Companies dependent on subsidy revenue without a credible path to fee-driven profitability face existential risk from the halving schedule. Mining stocks offer institutional investors a leveraged play on Bitcoin price appreciation, but the leverage comes with significant operational risks that must be explicitly modeled. Marathon Digital and Riot platforms have demonstrated betas to Bitcoin price movements of 3-5x, meaning a 50% Bitcoin price increase can translate to a 150 to 250% stock price gain. In a strong bull market, this leverage is attractive. However, the same leverage works catastrophically in reverse. During the 2022 bear market, mining stocks declined 80 to 95% from their 2021 peaks, significantly underperforming even the 65% decline in Bitcoin itself. The operational leverage of mining companies, specifically their fixed energy contracts, hardware depreciation, and debt service obligations, transforms a Bitcoin bear market from a painful drawdown into an existential solvency crisis for some operators. For institutions evaluating mining stocks, the investment thesis requires modeling 3 scenarios. Bull market, mining stocks outperform BTC significantly through hash rate growth and operational leverage. Sideways market, mining stocks underperform BTC as operational costs erode margins. And bear market, mining stocks dramatically underperform BTC and face solvency risk. The risk-adjusted case for mining stocks over direct BTC exposure is clearest for investors with high conviction on BTC price appreciation and tolerance for 80% plus drawdowns. Energy cost is the primary determinant of mining competitiveness, and the global distribution of cheap energy has shaped where mining infrastructure is built. The most competitive operations exploit energy that would otherwise be wasted. Stranded natural gas flared at oil fields, hydroelectric surplus in regions where generation capacity exceeds local demand, and curtailed wind and solar power that grid operators cannot absorb. Texas has emerged as one of the world's premier mining destinations precisely because its deregulated grid structure creates opportunities to purchase electricity at near zero or even negative prices during periods of oversupply, while interruptible power contracts allow miners to shut down during demand peaks and sell their electricity allocation back to the grid. This bilateral flexibility, impossible in regulated utility markets, allows Texas miners to achieve effective electricity costs well below the national average. For institutional investors in mining companies, energy strategy is a key due diligence dimension. Companies with long-term power purchase agreements at sub-3 cent per kilowatt-hour rates, diversified across multiple jurisdictions, are structurally advantaged over operations dependent on spot market electricity. The energy strategy directly determines the marginal production cost, which in turn determines the price floor at which the operation remains viable through crypto market cycles. The Bitcoin mining industry has experienced multiple existential crises in its short history, and institutional investors should treat mining company investments with the volatility and risk tolerance appropriate to early-stage industrial commodities businesses. The 2021 China mining ban is the most dramatic example. Overnight, approximately 50% of global Bitcoin hash rate was forced to relocate, creating a chaotic period of miner migration that temporarily depressed mining economics and triggered significant selling pressure. Hardware obsolescence is a continuous, slow-moving risk that compounds with each mining cycle. The shift from CPU to GPU to FPGA to ASIC mining demonstrated that hardware generations can completely obsolete previous infrastructure within 2 to 3 years. Current generation ASIC miners from Bitmain and MicroBT have efficiency ratings measured in joules per terahash, and each successive generation reduces this figure, making older hardware increasingly uncompetitive at current electricity prices. For institutional due diligence on mining companies, the fleet age and efficiency distribution is a critical metric. A mining company with a fleet averaging 3-plus-year-old hardware faces not only current efficiency disadvantages but a significant upcoming capital expenditure requirement to maintain competitive hash rate share. These capex cycles, poorly timed relative to Bitcoin price cycles, have caused several mining companies to take on debt precisely when their capacity to service it was most at risk. Bitcoin mining economics sit at the intersection of energy markets, industrial operations, capital markets, and cryptographic security. For institutional investors, miners are simultaneously economic actors whose behavior influences Bitcoin supply dynamics and investable companies offering leveraged Bitcoin exposure with distinct operational risks. The most important institutional framework is to separate the analysis of miner behavior as a Bitcoin market factor from the analysis of mining company stocks as an investment vehicle. Understanding miner selling pressure, hash rate dynamics, and halving economics is essential context for any Bitcoin investment thesis, regardless of whether the institution holds mining stocks. This market intelligence has value independent of direct mining investment. For institutions considering direct mining company investments, the risk-adjusted case is clearest for operations with demonstrated energy cost advantages, modern hardware fleets, conservative balance sheets, and management teams with track records through multiple market cycles. The operational leverage that makes mining stocks attractive in bull markets is a double-edged sword that has destroyed investor capital in multiple bear markets. Size accordingly.